What's up, you guys? And today I want to talk to you guys about the misconceptions of the home mortgage interest deduction, or HMID. I've been seeing a lot of stuff and people talking about how keeping a mortgage is a good strategy because you get to write off the interest of the mortgage interest and are using that as an excuse to not pay down their mortgage quicker. And I kind of wanted to debunk that because I think that is misinformation, or at least half the information. Everything that I've known in the mortgage industry and the banking industry tells me otherwise. But I just wanted to give you a different view. If that's all you've heard, if you've heard that through the grapevine, from a friend or from a YouTuber or from wherever, a banker probably most likely, or a realtor, that having mortgage interest isn't that bad because you get to write it off. Well, that is wrong. So here are the two biggest misconceptions that are out there. The first one is everyone with a mortgage gets a tax break. The second misconception that's out there is you can deduct the total interest every year. Now, I think one of the biggest issues that people aren't addressing is that the Tax Cuts and Jobs Act, this TCJA that passed in 2017, really changed the game. And while many people did utilize the deduction, the fact that the Tax Cuts and Jobs Act pretty much doubled the standard deduction caused a huge number of people to just take the standard deduction. And why is that important? Well, regarding the first misconception, everyone with a mortgage gets a tax break. Well, you've got to itemize. So no, not everyone that gets a tax break, everyone that has a mortgage just automatically gets it. You have to itemize. You can't get the tax break if you take the standard. So these two are wrong, these two misconceptions. So let's look at misconception number one. Everyone with a mortgage gets a tax break. And like I mentioned before, you must itemize. So you just don't just get it automatically. And the other thing is most people, like I mentioned, are taking the standard deduction. Out of 16 million itemized mortgages, or 16 million people are expected to itemize their mortgage, but there's 80 million mortgages outstanding, and that's from a recent study. And so that means 80% will take the standard deduction. So that's most people. Most people will take the standard deduction. And why is that? Well, the standard deduction, this is our 2020 numbers from the IRS right here. For a person filing single, the deduction amount is $12,550. Married filing jointly is $25,100, and the head of household is $18,800. So, in order for you to itemize, you basically have to have more deductions, total deductions, than the standard deduction. Otherwise, it would make no sense. But that's a lot. That's nearly doubled since previous years. So I think a lot of people are just not catching up to this fact. So they're using like pre-2017 ideas that keeping a mortgage interest is still a beneficial deduction, which it is if you're itemizing. But again, not many people are itemizing anymore. The standard deductions are huge.
That's what she said. Or he said.
So misconception number two, you can deduct the total interest every year. That is wrong. You can't just deduct the total interest. It's not a dollar for dollar credit. It's not a credit. You just don't automatically get all your interest that you've paid as a deduction or as a credit to your tax liability. So it's not a tax credit. It's actually based off your personal tax rate. So just to simplify this, let's look at the IRS 2021 rates. So if you look at this chart on the left, you'll see a column for rates, and it's as low as 10% all the way up to 37%. So those are the tax rates for people. And you have for single individuals, you have for married individuals filing jointly, and then for head of households. So it depends on how you're filing and what income range you are in. That will depend what kind of tax bracket you're going to be in. And to keep it simple, that's essentially what you are able to deduct is a percent. That's a fraction of the the fraction of the mortgage interest that you've paid in that given year. So no, it's not 100%. It's not 100% of your mortgage interest that you get to deduct. It's going to be a percentage of it based on your personal tax bracket. So that's the second misconception. So I want to show you guys this loan amortization schedule that shows the total tax deduction. And I want to compare that to actually paying off your mortgage, as I recommend and many people recommend, versus keeping your mortgage, as some others have recommended, which I think is crazy. And a lot of it's just because they haven't ran the numbers. So in this scenario, we have a loan amount of $150,000 with a 4% interest rate. It's a 30-year mortgage and is of 2021. Currently, there's no additional payments. So you're going to just pay the loan off as, the minimum payment, and you're just going to accrue interest over 30 years. Of course, most people won't do that, but the average person does jump from home to home, and they typically stay in a mortgage of some kind for at least 30 years, if not longer. It's just a different mortgage. But in this scenario, we're going to see that the total interest here that someone would pay in 30 years is $107,804. Now here, so there's no additional interest saved because they're just paying the whole amount, but there is a total tax deduction. So this is based on the 24% tax bracket. So this individual or married filing jointly or what have you is at the 24% bracket. And that's how much they get to deduct. So and this calculation gives it a total savings of $25,873. So that's their total savings here. Now, watch what happens if you do pay off or pay down and add an extra $500 a month to your mortgage. Look at what it does to the calculations. It's incredible. So you see here, the total interest saved is $64,000. Before it's like 108,000. So it's like almost half that you save in interest that you're not paying. The total, you do have some tax deductions, and so your total savings $74,000. $74,000 compared to what? The 24. Let me delete this. So you have $74,000. I'm going to delete this versus the $25,000 in savings because you're taking advantage of the so-called tax deductions. Mind you, you have to itemize. You would have to qualify. You would have to be able to have so many different itemized items, that you're able to itemize in order to even take advantage of this. Most people won't or don't. So again, $500, you're paying it down. And another thing is that the actual number of payments is only 160, which is about 13.3 years. So you get to pay this off in 13 years. So think about all the payments you're not making for the rest of the years, that you're not paying, and you have a asset that's paid off that you're not paying any interest on. So just something to think about when you hear people talking about how mortgages, mortgage interest is tax deductible, and you don't want to, don't miss out on the tax deduction, and don't pay off your mortgage early because you're gonna miss out on your tax breaks, and do the math, figure out what's best for you, and don't listen to all the hype that's out there. Do your due diligence. But that's it. I thought I would share this information. Hope you found this informative or entertaining or what have you. That's all I have for this video. We'll see you guys on the next one. Oh, and if you are new to this channel, please consider subscribing. Your support would be greatly appreciated. We'll see you on the next one. Bye-bye.